He says the dollar has indeed reached its peak, now looks overvalued. It's downhill from here. He joins us now. Great to get your take on this. Why?
So, Guy, I think what's going on is that we are transitioning into currency markets from a focus on relative monetary policy. And last year, the Fed moved in front of a lot of other developed central banks. But I think the key for this year is going to be currency markets are going to focus on relative growth differentials. My mind is working towards sort of 2017. We had a very broad-based global growth backdrop. That was an environment where the dollar weakened. I think we're going to transition into that environment now, in an environment where global growth is doing okay as we transition to expansion. I think the dollar tends to lag a lot of other currencies. So that's kind of a big thesis of why I think the dollar has certainly peaked. And it's not going to be a one-way trade lower, but I think the bias is for it to head lower in 2022.
So based on that, I wonder what currency has the most re-rating opportunity. If it is about growth, what currency and what country is going to have the better growth relative to the U.S.?
So our bias is towards a lot of those beaten up G20 currencies. I think the euro and yen, euro could do better, but we're using G3 currencies, the dollar, the euro and yen as funding currencies. I think the higher beta currencies are going to be more in that G20 universe. And within that, I think commodity currencies still have legs to do well. Again, as your prior guest said, hey, valuations positioning, it's all leaning towards dollar strength, but that's how it kind of gets started in here. And I suspect that will align with the fundamentals, which again point towards a lot of these commodity currencies, both in EM and DM, to do better.
Jack, how quickly does this happen and how much volatility comes with it?
Yeah, that's a tough one. I'm not a trader. We're investors. We have a longer term time horizon. We're willing to take on a little bit more volatility. Guy, I think that the key is China, because, if we're talking about global growth, when we have to talk about China, and I think China needs to move away from their zero COVID policy. They need to do more stimulus. If we're right and they do both, then I think this could happen sooner this year.
So I guess then my question becomes, how do you price the inflation risk then to that?
Yeah, and it's a great point, because one of the things that we're not used to dealing with inflation. We hadn't had to deal with it for a decade plus right now, and this is again part of my thesis why the dollar could weaken, is because I think we've kind of hit that part of the cycle where other countries, central banks, governments are going to actually embrace stronger currencies. We haven't seen that for a long time. They tend to talk down their currencies. I think they're going to be open to having their currency strengthened, and we need central banks to continue to tighten, particularly in the emerging market space. So, that's kind of where I incorporate inflation into this forecast.
Jack, if the Fed goes 4 times this year, if it ups the ante in terms of QT, if it delivers more than the market is currently expecting, how big a wrinkle will that be in your thesis?
Yeah, it's interesting. I mean, it's amazing. I mean, the Fed has transitioned very quickly from going slow to being very hawkish. But even in that transition, if you look at the dollar, particularly versus developed market currencies, it didn't do anything. So again, I think it's already sort of discounted. Is the Fed going to tighten 5 times this year? I don't think so. I don't think they're going to go 4. So I think that scenario is fully reflected in the dollar price.
I'm also trying to struggle with, and bear with me on this question, which central bank is actually tighter, the ECB or the Fed? In that, we have the Fed with super high inflation that they have to tamp down, and we're looking for rate hikes, et cetera. But the ECB, they're not going to hike anytime soon, but they're still talking about changing their asset purchase program, getting rid of PEP, moving some of that to their traditional asset purchase program, yet inflation is not even a third of what it is here in the U.S. What is policy really like in the underlying economy in Europe?
So, Alex, you're right. And that's why, again, I think currency markets are shifting from, hey, what the Fed is doing versus the ECB. It's going back to kind of economic growth drivers. And again, Europe is not a leader of economic growth. The rest of the world has to do well from a growth standpoint, and then they kind of drag the euro and Europe higher from that standpoint. But I think, again, when you sort of look at the valuations, the euro has certainly lagged in here, that things are lining up where we certainly could start to see more euro strength in here. We're underweight the euro, but we're along the Polish zloty, the Swedish krona, Hungarian forint, higher beta plays in that European currency space.
Russian foreign policy, how does it fit into those last three that you mentioned there? We've just heard from NATO, the Secretary General, talking about the risks. The Poles have spoken this morning that they're really concerned about war in Central and Eastern Europe. Jack, how would that fit in?
Yeah, it's never easy either. Again, I'm being very simplistic in our conversation today, but there's always geopolitical risk, and it's always a challenge to manage portfolios for geopolitical risk. You have to be aware of them. Hey, they're fat tail events by their nature, but I think it's more rhetoric right now. Clearly, things could change, and if it does, then the dollar, which acts as a risk-off currency, is going to do well, and we'll have to rethink the scenario.